quarterly economic update. A lot has changed since then, and this session really is about bringing you up to date in an hourly news cycle. I hope you'll appreciate that that's sometimes difficult to do, but also answer your questions, and we've got some ideas as well that we can run through. So just to start, a recording of the session will be sent to all registrations, and we'll also send the slides. If during the session you have extra questions or anything comes up, please use the widget on the right-hand side and send those questions through. We'll try and get through as many as we can. We've already had some come through before, so we'll answer those as we go along and also at the end. But please send those questions through during the session and we'll get to as many as we can. We're all in different locations today, and I hope you'll forgive us if there's any variance to our usual quality, but we're absolutely trying our best and I'm sure it will work very well. A reminder today, as always, that we're talking about general information. Anything that we do discuss is not personal in nature, and obviously past performance is not indicative of future performance. The regular content that we are still producing can be found on our website. Please keep up to date. Our weekly newsletter and our Monday morning Bassanese Bites. You can sign up for that on our website. David is updating and sending that out on a Monday morning. You can also follow us on social for up-to-date and regular updates as well. Please visit our website for fund information, investment insight, and all the details. Moving on, I'm joined today by David Bassanese and Adam O'Connor, Director of our Capital Markets. Hopefully you'll all be familiar with David Bassanese, our Chief Economist. So I think we will move on and I will hand it over to you, David. Welcome.
Thanks very much, Sarah, and thank you all for joining in again today in obviously what is a very volatile and uncertain period, both for the economy and for financial markets. So I do appreciate your time today, and as Sarah mentioned, it's a very fluid situation. Everybody's trying to come up with the answers and know the way ahead. I will try my best to sort of tell you how I'm seeing things, and definitely in terms of the coronavirus. I mean, clearly in terms of the economic outlook, as I was just saying this morning, really to have any sense of this virus, the economic outlook, you really have to have a good sense of the virus and you know, the best and worst case scenario. So just in terms of the agenda for me today, I will be talking about the coronavirus in a lot of detail because that really does set the economic outlook. Then I'll touch on what it all means for markets and what is the market outlook thereafter. And then before handing over back to Sarah and my colleague Adam to look at some specific investment ideas, just to really remind you all of the diversification building blocks, the power of diversification, certainly in times like this. And so I'm just going to touch on some of the ways in which you can build a diversified portfolio using some of the funds that we have available. So with that, let me first start with the coronavirus situation. And as you can see here, really what began in China way back in January, or in fact it began in late December, but no one really knew about it. It unfortunately started to, began in a wet market, so to speak, in the one province of China, or the city there, and the number of cases started to escalate. China tried to get on top of it, but they hadn't closed their borders and their travel quickly enough. And, many people, it's a big city, so many people travel in and out of that city, and many obviously went around the world in the weeks before it was able to be closed down. And so it has spread to Europe, to the United States, obviously to Australia. In fact, at the moment, so we're looking at about 46,000 cases and about 21,000 deaths. 113,000, by the way, have recovered. So just bear that in mind. So that's really the situation. Has been that rolling spread of this virus. It's really just been this slow motion horror story, really, starting in one corner of the world and just gradually rippling out across the rest of the world, and us having to deal with that as a consequence. Just on the next slide, just to really dig into this, this is not the first pandemic the world has faced, and I've really just tried to document some of the various, well, the biggest ones that we faced over time. Obviously, most famously, the Black Death back in 1300s. And the death rate back then, according to the historians, was around about 80%. So if you got if you got affected back then, the chances are you're going to die was pretty high. Then you had the Spanish flu, most recently in 1918. Again, the actual death rate in terms of those affected is seen as around about 5 to 10%. Though experts do say a lot of the deaths were caused by just the relatively poor health systems at the time. And their actual best estimate of the percent of people that died just because of the Spanish flu was probably close to 2.5%. More recently, we've had the Asian flu, the Hong Kong flu, the swine flu in the 50s and 60s, and more recently 09. Now, these were quite widespread, but the death rates were fairly low. So, a little bit higher than the common flu or common cold that goes around the world every year, but just really added another layer of deaths. So the coronavirus, as you can see there, is distinguished by, at this stage, it looks to be as contagious as previous pandemics, including the Spanish flu and all the flus that we've seen in the 50s, 60s, and in 09, but at this stage with a relatively high death rate. Now, at the moment, if you look at the ratio of deaths to those infected, it's about 4%. But again, the one question here, as I'll dig into this, is that we're very unsure how many people actually have the coronavirus. There could be a lot of cases that are going undetected. All we do have is the reported number of cases. And if you look at some countries where they've probably tested and have a better handle on this, the death rate is closer to around about 1%. So as I say here, I mean, the best estimate by the experts is that the death rate is around about 1% at this stage. Which, that said, is still at least 10 times worse than the annual flu. So hence the problem. Potentially widespread coverage, and if everybody gets affected at the same time, that can really clog up the healthcare systems. Again, one challenge at the moment is that it is, and again, this is what we're seeing over the last few weeks is there's still a lot of uncertainty, really, of exactly how severe the coronavirus will be. So, for example, some countries, in Italy, 10% of those that have been affected have died, so the death rate is quite high. In the US at the moment, again, it could be early days, it's only around about 1.4%. In Korea, that's probably been through the worst of it, at least the first wave, it's only around 1.3%. Australia, again, early days, only 0.4% death rate. So there's no real consistent pattern at the moment, which is, again, one of the challenges to think about this going forward and how policy needs to respond. Now, despite all that uncertainty, as you can see from the next slide, this has really dictated government policy at the moment and really why markets have fallen so far in the last month. Essentially, again, if you think back to China when we first had the outbreak, there was a lot of, China basically closed down its economy, or certainly closed down the major province that was most affected. And we were really in shock and awe at what China was able to do, and it did help to flatten the number of cases in China, at least temporarily. But again, the reality has been the big change over the past month is what China had to do is what everybody seems they have to do. So we've really gone into lockdown in many other countries around the world. And it all comes back to this sort of chart. This is a chart from Imperial College London. There's probably the leading experts in this area who've done a number of simulations, and they point out that if left unchecked, given their best estimates of infection rates and the percent of people that need to go to hospital and need ICU intensive care treatment, if left unchecked, you can have a major spike in infections, something like multiple times the demand relative to supply for hospitals and for ICU beds in particular. And so they came up with various scenarios to so-called to flatten that curve. And as you can see there, the blue line there is actually this is a simulation based on a 5-month period of social distancing, closure of schools and universities, very good tracing of anyone who gets who has the symptoms and is then diagnosed and is then isolated. So you need all these things in place, and they think that's what will be able to flatten that curve and avoid the overrun of hospitals, as we're seeing at the moment in Italy. So at the moment, again, given despite the uncertainty in terms of how serious this may well be, governments aren't taking any chances and essentially going into lockdown to avoid that spike. Now, one of the challenges, again, going forward, when we talk about the outlook, is that, again, the experts say that if we just do that, if we just lock everybody down, yes, but because people aren't sort of, mixing, the rate of infection will clearly drop. But if we do nothing else, then as soon as we lift those restrictions, you can get a so-called second wave, and they've actually modelled that there in the green line on that slide. And we saw that with the Spanish flu in 2018. So some would argue lockdown, what's the point of a lockdown? Well, the point is to basically buy time so that you can get good testing systems in place, so that once you go out of lockdown, you can basically, if anyone has any symptoms, you can test them, you can isolate them, you can test everyone in their immediate family or anyone they've been in contact with, and therefore try to dampen it down. And or hopefully there's maybe a chance of a vaccine down the track. And again, there's some debate as to how quickly a vaccine or good drugs, at least to treat the worst symptoms, may be developed. Typically, it takes at least 18 months to 2 years. There's a lot of work going on maybe to be somewhat quicker than this. But that's the scenario at the moment. That's the science behind what we're seeing now in terms of the very stringent measures being taken by governments around the world. And I also say there, I mean, one of the other challenges, of course, is some estimates suggest there could be 20% of people that have the virus that don't show any symptoms, which is going to make containment very, very hard. There's another line of researchers that are saying, well, you know what, based on our estimates, it could well be that a lot of people already have the virus or have had it, and actually, and as a result, it's actually a lot more prevalent than we know, and as a result, the percent of people that are needing hospitalisation and ICU treatment could be a lot less. And so, really, there's a lot of uncertainty in terms of the outlook because of all these different results at the moment. But at the moment, the key issue is that governments are basically locking down to buy themselves some time. Now, lockdown is not without consequences, as you can see from the following slide. China, these are some of the first official estimates that came out. Because China went into lockdown first, it was able to have the first sort of real economic indicators of the impact on the economy. And the PMI indicator, so there's a manufacturing and service sector indicators in China for February, really fell off a cliff, much weaker than markets expected. It was quite a shock, and we are starting to see that happen. Europe, I think, recently came out with, came out with their PMI indicators for February as well, and they've been quite weak. And the March ones, when they come out, will be even more horrendous. And just a heads up, well, actually, I'll talk about that in a minute. But so that's the sort of thing we're looking at. And as you can see from the next slide, China, again, this is the big difference. This is what's turned a correction in the stock market, like a 10% decline, because we were worried about a slowdown in the Chinese economy and disruption to supply chains, to a bear market and global recession, because everyone's basically had to follow China's lead and go into lockdown. So there's just some photos there for around Europe, New York, Paris, Venice, Australia. I mean, it's quite shocking, to walk around the streets now and see how empty they are. Unfortunately, the only people on the streets are those lining up at Centrelink to get unemployment benefits. So some estimates, around 1 in 5 people around the world are now under lockdown, to 1.7 billion people. And India only yesterday announced a lockdown for 21 days. So it's another 1.3 billion people being affected. So what's the outlook in terms of what are these lockdowns achieving? This is a chart of deaths, number of actually. So again, given the uncertainty of how many cases are actually being, or how extensive is the virus within countries, there's a gravitation toward focusing on actual death rates. I know they follow infections with a lag, but at least it's like a real piece of evidence. We do know if someone's died of the virus, then clearly they had it. And as you can see here, there's different paths going on. So China was ahead of the game. They've managed to flatten the curve, so to speak, or get on top of it. So the number of deaths from the virus in China has flattened off. Italy, it's still escalating, but there's, in fact, in recent days, very tentative signs of an easing there. But other countries are not as further along in that journey. The bottom line, I mean, some of the estimates suggest it may take, 3 weeks to a month of lockdown to get on top of this, at least get on top of the first wave, and then we can sort of work out what to do thereafter. Can we lift the restrictions? Will we be in a capacity to be able to do that? If you look at it from, just going to the next slide, if you look at it on a city basis, also differences. So the Wuhan in China was able to get on top of it. Tentative signs that in Italy, Lombardia is being, slowly but surely perhaps being able to get on top of it. And we're seeing early signs of, again, if you look at Washington State in the US, which imposed restrictions somewhat earlier than New York and even California, the death rate there is, not going up as fast as we've seen in some other cities. So that's really the situation at the moment. And again, tentative signs that maybe even in Washington State, their lockdowns are having an effect in starting to contain the spread of the virus. In New York, at the moment, it's still escalating and very rapidly. So it means a wait and see. Just in terms of the economy, some tentative signs of hopeful signs. So this is, again, real-time data from Beijing showing the traffic numbers relative to the situation same time last year. And if you just look at the more recent numbers, it's just showing that, life is slowly but surely getting back to normal in China at the moment as restrictions are being eased. Now, again, as I recall, one of the risks with China, and again, there's some concern that they may not be reporting this fully, but again, without a vaccine, unless there's very proper testing in place, if you open the restrictions up, there is a risk of a second wave. And again, for markets, if we do see a second wave emerging in China, that's going to be very, very negative news, because it'll just show you that, lockdowns in and of themselves don't work. But at the moment, there's hopeful signs with regard to China. And the other hopeful sign is just with regard to the drug and vaccine situation. So I've just got a table there of all the various drugs that are being mooted as potential solutions here. Some are being tested, some are starting to be trialled. I won't go through it in detail, but just some of those are showing some promise. But again, the big debate is, will it take 18 months before these can be widely available, or will it take only 6 months? The other thing I'll just quickly point out is that, again, it's such a fast-moving situation. Just overnight, there's some reports out of UK where they've developed a test that can be made available in chemists, where people can test themselves and get an answer within 45 minutes as to whether they have the virus or whether they've had the virus. Because the other thing is, if you've had the virus, again, the scientists suggest you're not contagious any longer. You don't have the risk of reinfection quickly, so you can actually probably then, go about your business and move out of lockdown. So if that sort of testing becomes widely available, and it turns out, well, you know what, 50% of us have already had it, it will change this situation quite a lot. So again, it's a very fast-moving, fast-moving situation at the moment. And I guess I don't have some forecasts here of the economic outlook, because again, it's so dependent on how serious this virus is. If it turns out that, it's not that, a lot of people have already had it, and the actual number of people that need to go to visit a hospital and ICU ward is not that high, then the decision may well be made, and Donald Trump's mulling this at the moment, is, well, maybe the solution is worse than the actual disease itself, and maybe we'll ease lockdown and try to deal with the cases as they arise. So that's another scenario that could develop. But before I move, so just let me move on in the interest of time, talking about the market outlook. So just as you can see with the next slide, I'm focusing here on the US market. So we've really had the fastest bear market in history, down 26% in 18 days, and actually took 30 days in the Great Depression for the market to decline by 28%. So it didn't obviously hit 20% in one day, but the day that it broke through 20% was after day 30, and it got to 28%. So quite remarkable times to be in investment markets. The fastest decline in the US market in history. Now, the US clearly will have a recession. I mean, I haven't mentioned that, but I mean, I think in terms of Australia and the US, there's no question now we're going to have a very deep recession in Q2, at least in the June quarter. And again, just whether that is short or an extended really depends on whether or not this virus turns out to be a lot worse than expected. So some horrible numbers being bandied about: a 10% unemployment rate in Australia by June, a 20 to 30% unemployment rate potentially in the US. But again, if we get on top of this and the restrictions don't need to be reimposed, those unemployment rates could drop down fairly quickly by Q3 and Q4. At the moment, at its worst, the market has been down around about 35%. Historically, as this chart shows you, I've got bear markets in the US in times of recession and in times without recession. So as you would expect, when you get a bear market with a recession, the declines tend to be deeper and last a longer time. So just as an example, the average bear market decline in the US is 28%, but during a recession, it's closer to 40%. And the last two bear markets in 02 and in 07, the GFC, did have declines in the market of around about 50%. Obviously, the Great Depression was the worst case scenario where the market did decline by 90% over an extended period, but basically because they had a very weak economy and there was no macro stimulus in those days. It took them a number of years before they said, you know what, we should stimulate the economy to try to get out of this. So my base case is that at 35, there's probably a little bit more weakness to come. My base case is that the market, given the rising infection rates in the United States, given the weakness of the economic data we're likely to endure for a while, it may well decline somewhat more, and maybe sort of a 50% decline is more likely to see the bottom rather than only a 35% decline. But again, it really depends on how this virus plays out over the next few weeks. But that would be my base case. And actually, if I just go, and something to look out for will be the cycle. If you think about how this will play out, so basically we've been in a negative cycle. We've had rising infection rates, reactive policy responses, as in lockdown. Share markets have declined. Economic data is weakening, and obviously corporate earnings. We haven't seen that yet. The corporate earnings will obviously decline in a big way too. So we're in that negative spiral at the moment, but the hope will be that the reactive policy responses will gradually lead to falling infection rates. And as I said, very tentative signs that Italy also is starting to see a decline in the rate of new infections, the rate of new deaths. And then hopefully we can get into this positive cycle where as infection rates decline, share markets can stabilise, governments can ease policy restrictions, and data and earnings can start to improve. So bottom line here is I think share markets will stabilise well before the economic data even bottom. So, we could have the market stabilising even in the midst of very, very weak economic growth because it's looking forward and saying, well, you know what, we've got on top of this, policy restrictions are being eased, and as a result, there's good chances that the economy could thereafter recover. Just some scenarios. So the V would be, containment within weeks, and then no second wave because we're able to have good testing and tracing in place. And so, for example, in the US, if Donald Trump opens things up by April 12, as he's suggesting, and there's no second wave, either because they have, got good controls in place, and or it turns out, the virus is not as bad as we feared. The percent of people that do get infected that need to visit a hospital is not as high as we expected. That's the sort of V-shaped recovery. The U will be the lockdown needs to, again, one of the challenges will be with this lockdown is to what extent the public do actually adhere to the restrictions. So, we're seeing signs in the UK and to some extent even in Australia and the US that, people aren't following these lockdowns, and as a result, it may take slower to get on top of the rate of new infections, and as a result, the lockdowns may be extended for a period. So that's the U-shaped recovery, and then hopefully once we get out of it, the vaccines and testing or tracing can be in place. And the worst case scenario, unfortunately, will be repeated lockdowns. We're going, again, if the rate of infection in China starts to rear up in the next few weeks and they go back into lockdown, that would be a gut punch to the global markets, basically, because all hope of this being resolved pretty soon will be dashed. So look, I'm hoping for a V. I'm hoping for a V that either the virus turns out to be not as bad as feared, or there will be good testing in place once we get on top of the rate of infection within a few weeks. It takes about a week for people to develop symptoms. So if we had full lockdown, basically everyone who had the virus would know it within a week, and then they could go and get tested, and then they could be isolated, and anyone that they've been any of their immediate family, for example, could be tested as well, and so we could sort of keep a lid on it that way. So that's the scenario. I'm hoping for a V, but I would say a U is more likely. A bit of a, maybe the lockdowns will last for a couple of months, and as a result, markets may not have seen bottom. They probably need to weaken somewhat more over the next couple of months because of just disappointment of how long this lasts. Before I hand over to my colleagues who'll talk about some investment ideas with those various scenarios, I just wanted to touch on the building, just to remind you all the building blocks that we do have. Firstly, just again to remind you, we have over 60 ETFs and ETPs available, and you can actually build a diversified portfolio using a number of products. So just listed there: cash, floating rate bonds, government bonds, bank hybrids, property, Australian equities, international equities, and commodities. We have building block ETF asset class exposures through ETFs in all of those areas. And just as an example there, that's a balanced portfolio with exposures to all of those assets, 50-50 growth versus defensive assets. And the weighted average management fee for that would only be about 36 basis points, so 0.36%. If you want an all-in-one solution, we do now also have a range of ETFs that basically combine both growth and defensive assets in one ETF, and depending on your risk profile, you can have a very defensive allocation, so 25% to growth, which is essentially equities, and 75% to cash and bonds, all the way up to a more growth-orientated exposure with 90% growth and 10% defensive. So in one ETF, you can get a diversified portfolio catering to your particular risk preference. And all of these have a management fee of only 26 basis points, of 0.26%. And just to look under the hood, one of the features of our listed diversified portfolio ETFs is that we really source ETFs to be part of those. So essentially they are ETFs of ETFs. And so we give you asset class exposure through different ETFs, all packaged up into that one ETF. And as you can see, we source ETFs from around the world if need be. So some of our international exposures are actually US listed global equity ETFs, which have very, very low fees, which we net off and then pass back to you. So just to show you that you're getting very broad exposure across all markets within those diversified ETFs. Look, with that, I will hand over to my colleagues and stay around for questions a bit later. So thank you very much for your time.
Thanks, David. Thanks very much. A lot to go through there. Now, I'll join the discussion with Adam O'Connor, a Director of Capital Markets here at BetaShares. And David mentioned before that we have got the broadest range of funds available on the market covering all asset classes. So if we can just take it back to the scenarios and maybe just work through some options if people are feeling that, potentially they agree with David and what they can do about it across the BetaShares range. So Adam, David talked about the V scenario. It'll soon be over by the dip. So what are your sort of options or thoughts there?
Thanks, Sam. Just checking that I'm coming through fine there.
Yeah, sounds good.
Okay, great. Yeah, look, I think first and foremost, across the ETF market or the Australian ETF market more broadly, the majority of flows we've seen towards what we consider dip buying or people taking advantage, I guess, of these more attractive entry points for long-term asset allocation decisions, they've been going to broad Australian equities exposures. And what I would highlight is that while we know that you definitely can't control the market, what you can control is your costs. All four of what we consider the big four Australian broad market ETFs, they track a very similar market capitalisation weighted index, with the biggest difference really being the price that you're paying to track that index. You know, and that might seem insignificant when we're talking in percentage terms, but at the end of the day, it's money saved for you as investors. And for advisors, that's tangible savings you can make for your clients at this stage. So you can see here on the chart, A200 on a relative basis on dollar value terms to the other four major broad market Australian ETFs there. For investors that are looking towards the US, this has obviously been very much a US driven market. There are a number of scenarios that can play out from here, but if the recovery is V-shaped, which we're talking to in this scenario, we think there is a strong argument to preference the NASDAQ as an index, which is heavily weighted towards the major US tech names. I would say the S&P 500 is a comparable. And you know, this is a function of two things. You know, firstly, you know, when there is limited growth available, investors have shown they're willing to pay a premium for the fewer companies that they consider able to generate structural growth, irrespective of where we are in the economic cycle. And the other point that I'd make with regards to the NASDAQ is this. Under a V-shaped scenario, you're going to expect a period of earnings disruption impacting cyclical companies and those with heavy debt loads. And in that world, you really want to own the kind of business models that are going to be less impacted by economic forces and that actually may be thriving this environment. So, you know, some of the obvious ones that come to mind, you know, think Netflix with people isolated at home. We've got gaming stocks in there like Activision or Nvidia, and even Amazon. You know, they've come out over the week and said they're struggling to keep up with demand, not for logistics reasons, but because they've effectively become a central provider of supplies across the US, and people are leaving their homes. So, you know, this situation has really brought forward that structural shift that we knew was already underway from bricks and mortar to online retail. And, you know, Amazon are probably one of the world's biggest beneficiaries of this, you know, not to mention payment gateways like PayPal, you know, that are also on the NASDAQ. All right, I can see we're going back through the slides.
I'm sorry, Adam. I just had a freeze there. I really do apologise for that. I'm really sorry. But we're back on track. I'm sorry.
Doesn't worry, mate. We're all dealing with the challenges of working remotely at the moment. Yeah, look, we've got there eventually. And this is anyway what I was going to talk to at the end. My last point on the NASDAQ. You know, you want to hold companies in this environment that have the cash reserves to weather this market storm. If you look at you know, we've got here the 6 largest corporate cash balances in the world. 5 of those 6 are the top 5 holdings of the NASDAQ. So our point here is that when the dust does finally settle, you know, these companies are going to be in a better position to not only survive, but to displace those, you know, old economy incumbents. You know, I think your Walmarts and your Home Depots that, you know, otherwise may have struggled to survive in this environment. Look, finally, for investors that are, you know, potentially, you know, a bit more sophisticated and are looking to utilise leverage without necessarily having to use a margin loan or CFDs or warrants or other leverage products, GEAR and GGUS are funds that can provide a way to get exposure to the Australian and the US markets without the risk of having to lose more than your initial investment. Key points we have up here. These funds are internally geared, and the LVR is managed by us within a range of 50 to 65%.
Okay, so the second scenario that David spoke to, thanks for that, is a U-shaped. So the worst is almost over, but it's a much slower sort of recovery ahead. So what are the thoughts there?
Yeah, definitely. You know, in this scenario, which is the one that, you know, Dave said seems likely, and, you know, a lot of commentary's been in the market around, you know, we're saying that the worst is almost over. There could be a bit more downside to come, but, you know, that recovery is not necessarily going to be V-shaped. It's going to be a long way out of this. One option for investors, because, you know, you may want to stay invested in equities in this environment, in this scenario. You know, one of those options for the longer recovery might be to look at, say, your global equities allocation, or even if you're looking to allocate to some equities, and allocate to what we'd call high quality companies, or what are considered high quality companies. And in investment world, those are companies that have lower debt, they have stable earnings, and they have a higher return on equity. You know, despite, you know, a pretty broad range of reasons why over the long term we believe that investing in these metrics makes sense from that longer term asset allocation standpoint, what we've seen that's relevant to this particular scenario is, firstly, companies with these factors have historically outperformed through the slowdown and contraction phase of the economic cycle. As we've seen here, in the initial stages of a market shock, everything sells off at once. If you look at the start of the GFC, that first red arrow, you compare that to what we've seen in the last few weeks here, everything sold off at once as investors rush for the door. But in the GFC, while cyclical companies, highly leveraged companies, they continue to get sold down, high quality companies, where we've got the green line, they held up on a relative basis. They also began recovering faster and earlier. So our point here is, if you believe the worst of the market falls are largely behind us in the current crisis, the path to recovery is a long one, then getting exposure to quality global companies we think makes a lot of sense. Look, different part of the asset allocation mix, but, you know, one other option that you might consider as an alternative to bank equities or an asset class in its own right in this scenario is hybrids. You know, and we think it makes sense to do that via a fund. Obviously, we have HBRD, our active Australian hybrids fund, to get that exposure. With a slower recovery, you might expect significant headwinds for the profitability of the banking sector. I don't think that's a secret. That's bad for equity holders. But, you know, in this world, there's potentially limited risk to their actual solvency, which is what you're concerned about as a holder of hybrid securities. And what you can see here in this chart is, over the last couple of weeks, spreads on major bank hybrids have blown out to levels we saw at the peak of the GFC. This is despite the fact that post-GFC, banks have massively deleveraged their balance sheets and they've really never been better capitalised. They've also generally de-risked their business models and increased the conservatism in their lending standards. So if your view, again, is that the worst has largely been priced in here, or, you know, we're approaching that point, but the recovery will be slow, then owning bank hybrids over bank equity could be a potential option, particularly given the attractive spreads on major bank hybrids that are currently on offer.
Okay. The third scenario that David spoke about is one that no one really wants, and it's that L-shaped. So the worst is yet to come. What are some options there for investors?
Yeah, you're definitely right. It's a scenario no one wants, but, you know, a scenario that a lot of people, you know, are considering or trying to prepare for. You know, investors who do want to protect their portfolios for this scenario, they have a number of options at the disposal, and we have a number of options in our suite that can allow them to do that. We have a few listed here, which I'll go through before I go into a couple in a little bit more depth. I think first and foremost, which no one would probably be surprised here that we've seen a massive increase in interest in, are our bear funds. Bear funds can be used to hedge portfolios or to profit from further falls in the market. They can also allow you to manage that market risk without necessarily having to sell down equities and losing the income and franking credits associated with those positions, which, you know, for some people could be crucial at this time. Another option, second option, is simply to go to or to hold cash. You know, I'll go through it in a little bit more depth in particular next, but, you know, AAA, we believe, can provide a significantly better way to do that. We have safe haven assets in our suite, like gold. One thing I'd highlight about QAU, our physical gold bullion exposure, is firstly that yes, it does invest in physical gold bullion. It doesn't use derivatives like gold futures. And it is currency hedged to provide US dollar gold exposure. Now, this has become a more relevant consideration for investors in just the last week with the rapid fall in the Aussie dollar. As we've seen, and conversely, the massive rise in the scramble for cash of the US dollar, and we've seen this become a more relevant consideration for some investors. So if, for example, you were in an unhedged physical gold bullion exposure, you could consider switching that over to a hedged exposure to remove that currency. Looking at fixed income allocation of portfolios, we've seen fixed income sell off with other assets in this market due to the velocity of the recent sell-off, and as I mentioned, what was effectively a scramble for cash. But should this normalise, but economic conditions continue to deteriorate, we might expect equities to continue to weaken, but government bonds in this world would once again be considered probably one of the best portfolio diversifiers you can have, particularly as the market begins to price in the lower policy rates we've seen and the massive QE measures globally. And finally, we have our managed risk equities funds where an option could be for investors to potentially switch from their existing Australian or global equity funds into a managed risk solution, which does have an institutional risk manager managing that total equities exposure in the fund to try and manage the downside risk in volatile markets. So look, I just want to go into those in a bit more detail, particularly the bear funds. We've got a bit of an illustrative example here of how bear works. Key things to know about the bear funds more generally: they use exchange traded futures to get their exposure, and those short positions are allowed to vary in a range between negative and 200 and 275% on a given day for the strong bear funds, and for the bear fund, which we'd consider more of a one-to-one exposure, negative 90 to negative 100%. Just in terms of one of the more common questions we've had on these, we have been asked a lot if there's been a ban, or if there were to be a ban on short selling, would these be affected? My colleague Richard put a blog post up on our website last week, which does go into this in more depth, and I definitely recommend not only just for that anyone here review that blog post. It's quite insightful.
And sorry, just to sort of highlight for attendees, we have actually included a copy of that post in the handout section, and it is in the insights section. So a lot of questions around the bear funds and just further information and explanation addressing those questions in the handout section. Sorry, just to highlight that there.
Yeah, 100%. If you're taking the time to listen to this webinar, I'd say that particular blog post is almost required reading. And effectively with these funds, we're not short selling securities. As I mentioned, we use equity futures. Any short selling ban is going to be highly unlikely to extend to futures because they are considered an important part of the market ecosystem, particularly for their broad use by institutional investors for hedging purposes in much the same way as you might use bear or BBOS. AAA, just touching briefly on our cash ETF. This is our largest ETF in our suite by AUM. For investors who are looking to hold cash balances through this period, this is going to offer a meaningful pickup over your CMA account. And for clients with cash on platform, it's going to offer pretty meaningful pickup on that as well, because we all know that those rates have gone down pretty low. But because this is an ETF, you have that liquidity and optionality to take advantage of opportunities as you see in this market, without necessarily being tied down to a TD, which is going to give you a similar rate. And lastly, Austin World, our managed risk funds, which I mentioned before. The way they work is these funds have one of the world's largest institutional risk managers, a group called Milliman, and they manage the level of exposure in the fund using index futures, similar to what you might do with the bear funds on your own. But we have a professional manager in that fund adjusting the exposure to protect the portfolio on the way down, but also reducing that exposure on the way up. You know, and you can see the drawdown here and how that works. You know, in the most recent pullback, you know, at the moment, Australia's down 19%, where the S&P ASX 200 is down 32%. If you think this is going to fall more, the nature of this dynamic hedge is it hedges more of the exposure in line with volatility. So we're at a pretty large hedge now. If this is continue to go down to say 50%, like we saw in the GFC, Australia is going to be significantly more hedged than it would be with the direct market exposure. So look, for older investors who are worried about this scenario and want to better manage that risk in their portfolio, using a managed risk fund could be a potential solution from here and maybe even through the rest of their investing life cycle.
Thanks, Adam. Now, we've had a lot of questions and we've seen trading volumes across ETFs and our own funds increase during the recent market volatility. What are some best practice tips, or what are the 3 things you think are most important for investors to be keeping in mind at the moment?
Yeah, sure. I think in the current environment, this is crucial for us to touch on. I might, just before I go into ETF trading, just address some of the questions we've been getting around ETF liquidity and spread. Look, the key factor for ETF investors to understand is that ETF liquidity should always be considered in the context of the liquidity in their underlying holdings. Although spreads in ETFs are influenced by a number of factors, the primary factor is the liquidity in the underlying assets held by the ETF. And you know, the spreads or the liquidity in those assets at that given time is going to affect the spreads in the ETF. When volatility spikes, spreads in those underlying securities are going to widen, or I've seen with the US, you know, their futures have stopped trading altogether at times. This is going to be reflected in the spreads of your ETF. So back to ETF trading, what we've got up here is what I'd consider the 3 basic tenets of ETF trading. The first rule, I might just wait till that gets muted.
Yeah, we're good, thanks.
Sweet. Yeah, look, the first rule is use limit orders. Limit orders should be the standard practice of ETF trading, but they are especially important when markets are volatile. There's a great quote here, which I've had included. Ben Johnson, Morningstar's head of global ETF research, tweeted it the other day. And he said, use limit orders is the wash your hands of ETF trading, and he couldn't be more spot on. Limit orders give you control over the price that you're paying. And more importantly, they act as a safeguard against overpaying or being underpaid. If you use a market order and your volume is larger than what's being offered in the screen by the market makers, you're going to end up taking out orders below that in the depth screen. What you can do, simply put a limit order in. If it's bigger than what the market makers have, they will reload and they will hit you. But most importantly, you do not want to be taking out any orders below that in the depth screen. Second rule, avoid trading your market open and close. Again, this should always be a hard and fast rule, but get your trades done between 10 past 10 and 4 p.m. in our trading day. Just don't consider those auctions an option. You know, this is, again, more relevant during periods of heightened volatility. You know, those periods are auctions. Market makers simply can't set a bid and offer price they would in normal trading. And in fast-moving markets like we've seen, you know, you can have whole percentage points moves at the end of the day, you can have whole percentage point moves in the last 10 minutes of trading. And that's going to throw out the price that you're going to receive or pay. Look, and the final rule for international ETFs and futures markets is you need to know when the underlyings are open. You know, we say watch the clock. This is relevant for our commodities ETFs, which they won't have market makers in the screen here until 11 a.m. But as I said before about liquidity in the underlyings, you know, what we've seen in the last few weeks, US futures going limit up and limit down through our trading day. When that happens, it means there is no liquidity in the underlying, and that's going to be reflected in the ability of the market makers to set a price for the ETF in the screen. So yeah, those are the 3 points I just wanted to make around ETF trading best practice while I've got this forum.
Great. No, and again, we have a lot of information, and we've also got some six top trading tips. There's a few others for people to keep in mind in the follow-up email, and also on our insights section. Just some things to consider here, and I refer you to our website, PDS documents, and information about the funds. Before we move on to, or as we move on to questions, we've had a lot of comments, and I will try and fix that screen for you. But if I can just ask you, Adam, we've had a lot of questions about the widening of fixed income ETFs during last week's volatility. You have touched on it, but could you just further address the comment there?
Yeah, widening of spreads in fixed income.
Yep, fixed income ETFs. That's correct.
Sure. Okay, so as I mentioned above, liquidity of an ETF is always related to the liquidity of the underlying. And I did mention it a couple of times, but effectively what we saw last week was a global scramble for cash. And what happened there was a complete lack of buyers in the OTC bond market. And what I keep coming back to is, if there is no liquidity in the underlying market, and in this case, if there's no liquidity in the underlying bond market, spreads are going to widen as a function of that. One thing I would highlight is, despite there being no bids in many of the underlying bonds across the whole market, not only in Australia, but also in the US, which would mean if you held that paper directly, you're not even going to be able to sell down your positions. But despite that, the ETF did continue to trade and at least provides a form of liquidity for those investors that needed it.
Okay, and David, if I can just ask you, there's also your comments on the recent correlation between the equity markets and those traditional safe havens, such as gold and government bonds.
Look, I think it goes back to the same point that Adam was mentioning, where basically over the past few weeks, given the severity of the equity market decline, we've had a big dash for cash, really. People have had to sell their equities along with other more defensive investments, such as bonds and even in the cases of gold. So again, if people have made, in some cases, fund managers that have held diversified portfolios, they've made losses on their equities, and to make up for some of those losses, they've had to raise cash, which has meant selling some of their other investments. So the ordinarily in a risk-off environment, bonds would rally when equities sell off, and things like gold often will also rally. But what we've seen with the liquidity event, essentially that correlation, I think temporarily hasn't been evident. But I think it will start to re-establish itself. I think we've seen in the last few days that the scramble for US dollars globally, for example, because many companies around the world rely on US dollar funding. And so when the US themselves need a lot of US dollars, or US companies, that cash is less readily available globally. But that scramble for US dollars has now been eased because the Federal Reserve in the United States has been supplying US dollar liquidity lines to central banks around the world to in turn support their own companies. So that scramble for US dollars has eased, and we've seen as a result some of those tensions being resolved. So I would think that bonds now will start to trade more normally, and I think the other thing we'll see, gold, I think Adam has mentioned as one of those investments, may well start to do pretty well in this environment, because we're seeing budget deficits around the world just explode. There's going to be, and interest rates are going to stay very, very low for a very long time. And so as a safe haven investment, gold is looking pretty attractive relative to, cash and bonds going forward.
And just a question here on what you've been right before in the past, your current AUD USD currency forecast, where are you thinking that's going to head?
Well, it's very, very whippy at the moment. It's all, look, Aussie dollar is a global growth currency. So in this environment, when it's a risk-off environment and equity markets are being sold down, the Aussie will clearly weaken. I mean, it touched 55 cents at the height of the pessimism a few days ago. I did have a call of it going to 62 cents prior to the coronavirus, but just based on the relative weakness of the Australian economy. So I'm a bit neutral. It's basically gone where I thought it would go, and actually then I'd revise that to 58 cents as the crisis started to brew in recent weeks, and so we actually sailed through 58 cents very carefully. So it's going to be very, very volatile. It's going to trade in line with risk sentiment globally at the moment. So if we get a V-shaped recovery under scenario one, it can probably rebound to say 64, 65 cents, and that would be sort of where it would hold, closer to where I sort of thought it would be eventually. But in a worst worst case scenario, going back to the low 50 cents would be quite likely. So I think it's going to. So I don't have a big view different to sort of where it's trading at the moment. Sort of just under 60, around about that that sort of high 50 cent area, sort of where it's going to be, but would be my base case. But I said a huge uncertainty around that, and it's just going to depend on the global equity and the global risk environment over the next few months.
Okay, and just staying with you, Dave, your thoughts on the impact of the announced government stimulus?
Look, as you said, I actually did not mention macro stimulus in my presentation at all, in the interest of time. And I could have spent half an hour going through what every central bank in the world has done, what our central bank has done, what the government has done. But as I said, at the end of the day, in terms of the macro effect, it's almost, I don't want to downplay it, but it's almost irrelevant. I mean, when you tell everybody to stay indoors, don't go and get your hair cut, or get your nails polished, or what have you, or no amount of macro stimulus can help in that regard. And so it's really a band-aid on what is a gunshot wound through the chest of the economy, global economy, and our economy. So it's good. I mean, initially the first round of stimulus in Australia was to focus on trying to avoid a technical recession. So that first round of $17 billion worth of stimulus was really to try to get consumer spending in that June quarter. And because it's looking like the March quarter will be negative only because of the slowdown in the Chinese economy. But again, I think the June quarter now, everyone concedes will be negative. And I think, those that remember my last webinar, we were still debating that. Actually, it doesn't matter anymore. The government's locked, we've gone into effective lockdown, as has other countries. And so it's no question Q2 will be negative. No question we'll have a technical recession. What the government's now trying to do is almost just, people that lose their jobs can get by, trying to minimise the number of job losses through giving payments to small businesses. So trying to minimise the damage, but nonetheless, it's not going to change the situation. The damage, at least in the short run, will be very, very huge. And what we ultimately, the ultimate issue here is, how bad is this virus? Are we going to get second waves of this virus, or can we contain it? Either through better tracing, either through a ready vaccine very soon, or will it turn out to be not as bad as feared? And so they are really the key scenarios here. Macro stimulus or almost irrelevant.
Okay, and we've got a few questions about hybrids, and I just might ask you, Adam, just for some further clarification and thoughts on the hybrids and what you mean by the widening of bank spreads.
Yeah, let me just have a quick look. So in terms of the widening of bank spreads, hybrid is still a credit market, so it functions much in the same way as what we were talking about before with sell down in broader credit. So as there was more sellers than buyers in that market, credit spreads that they pay over BBSW blew out. I've got the chart up there of what that number went to. But as I mentioned, they're wider than we saw in peak GFC, when arguably the banking system was under significantly more stress, and the solvency of those banks was more in question.
Yeah, and there was there's been a few questions about, and I guess maybe both of you can address it, the risk of hybrids being converted to equity.
Maybe I'll have a go at this. I mean, one point I'd make about hybrids, again, I think the main point I want to share with you is that hybrids have again, I think, demonstrated as an asset class their defensive qualities in a risk-off environment. So again, hybrids have sold off somewhat, but certainly a fraction of what the equity market has done. So again, they've been disparaged in the past of being, bond return for equity risk. And as we've pointed out painstakingly over recent years, they're not equity risk, because when equities sell off, even during the GFCs, hybrids didn't sell off as much. And we've seen that again today. To the extent they have sold off, again, with equities at the moment, if they can maintain their dividends and whatnot, equities are looking like a screaming long-term buy, because obviously they're quite attractive from a dividend perspective. Unfortunately, in the case of companies, they may well need to cut their dividends over the next few months. Well, with hybrids, I think it's more assured that they will be able to keep paying their income obligations. And so with the sell-off, moderate sell-off in their prices, they are now offering even higher yields than they were prior to the virus. So I think they, in that sense, they are looking relatively attractive on a risk return perspective. But the issue of, okay, will they be converted into equity? Look, in the case of insolvency or where the regulators thought banks were potentially going to have capital issues, they could be converted. That's the nature of, that's why you're getting paid the yield you get paid. But I still think the risk of that happening, even with a deep, albeit potentially short-run recession in Australia, is still pretty low. What you may see, and in fact we saw that recently, is that to the extent hybrids are mature, investors will get paid out, or to the extent hybrids are sort of at their can be banks can basically give back investors their money and take back the hybrids. They then may use that and raise some equity through professional investors if they need equity. But I don't think the risk of, knock on wood, but I mean, I think the risk of anyone being forced to basically convert their hybrids into equity still seems pretty low.
Yeah. Okay. And a question. I don't know, Dave, if this is sort of your area of expertise, but a comment on the USD China currency.
As in, like, which direction it's going to go, yes. Or where do we think it's going to go?
Impact. The implication for the US and China.
Look, to be honest, it hasn't. I don't think. Look, I guess one risk was with the Chinese slowdown, China might have cut its weakened its currency a lot versus the US dollar, and I think maybe that's what they have been doing that to some extent, but. The big picture at the moment is that the US dollar in a risk-off environment, we've had a dash for cash. We've had a dash for US dollars globally because it's it's a funding vehicle that most global companies rely on. So that has helped strengthen the US dollar against many currencies in the short run. But I don't see, amongst all the things to worrying about the rate of the US dollar versus the Chinese currency, I think is not really a big issue at the moment. I think there's a lot more bigger issues to worry about.
Yeah, and I'm conscious that we've gone a little bit over. Adam, if I can just ask you one more question, and it's the use of the Bear suite of funds for SMSF investors. So are they okay to use for SMSFs? Oh, it does sound like we're just losing Adam. Dave, do you want to take that? I know that
my understanding is yes, they can be. Both the gear funds and the bear funds are perfectly legally able to be used by self-managed super funds. There's no reason why they can't. Whether it's appropriate or not, it's really up to you and your investment advisor. But there's no legal taxation bar, I think, to using those within your fund.
Yep, no, that's correct. So all BetaShares funds can be used should you wish in an SMSF. So I will leave it there, and I will just remind everyone that we will send a recording of the session and a copy of the slides. I do apologise for the little glitches that we had today, but obviously working out of our usual environment has presented a few little challenges, but I think we got there in the end, and the positive feedback has been great. We will send out the recording and the follow-up email today, and there'll also be some additional information about the bear funds. There'll also be some reminders and tips for when you are investing in ETFs. And I just thank everyone for their time. Thank you for coming, and you know, hope to see you again soon. We will run another session, and we look forward to sharing our insight and information with you all again shortly. So thank you very much. Thanks, Adam. Thanks, David.
Thanks a lot, everybody. Talk to you soon.